In the lecture series on personal financial planning, today I'll be talking about investment planning. Friends, in any personal planning, it's very important to accumulate wealth, to create wealth for yourself, for your future financial goals. As we have discussed many times in this lecture series, that every individual should make financial goals. These goals can vary from individual to individual, depending on the age, depending on the income group, depending on the risk profile of a person. Your goal may be to buy some material things, that is in form of your car, your expensive mobile, it may be your house, it may be buying foreign tour, going for a foreign tour with a family, right? Or it may be for your retirement planning, your children's education, your children's marriage, on social occasions. So there are different financial goals at different point of time in each of the individual's life. For achieving those goals, we make financial planning. And for a good financial planning, it's important to invest. The question is, what is investment? When I talk of investment, basically what we mean is that you, out of your income, whatever the income that is being generated by the individual, the part of the income is being spent, that is consumed, and rest of it is being saved. And that saving which you make, that you invest in a manner that you, recruit that investment, point out means you invest that investment in a manner so that that investment grows over a period of time and you can create the wealth over a period of time. So it means there are different options, different asset classes in which you can plow back your savings and you can depute your savings, and over a period of time those investments will give you either in form of regular income or in form of capital investment or in form of the growth, that is the capital appreciation, and thereby you accumulate wealth so that you can achieve your financial goals for which you are making the investment. So again the question is, what exactly the investment means? It means the growth of money over a period of time. That is, you depute your savings in a manner so that over a period of time this savings of yours can grow. The question is how it will grow, right? So for that investment is required. It is a monetary asset which is purchased with the idea that it will give you return in future. And when I say return, return is in two forms, either in the form of regular income, flow of income, or in the form of the capital appreciation. If I take an example at this moment itself, if you buy, say if you make a bank fixed deposit, to take a very simplistic example, suppose you deposit 1 lakh rupees in the fixed deposit of a bank, which fetches you 7.5% interest. So it means you will have a regular income of 7,500 rupees per annum. And after a period of time, if you make an FD of 5 years and if you are not withdrawing that money, that 7,500 rupees every year, if it is being compounded on a 6-month basis, on an yearly basis, so the next year the interest will be on not on 1 lakh rupees, but the next year the interest will be on 1,07,500. I am presuming the compounding is being made on an annual basis. And in the third year, the amount will be not 1,15,000 rupees, but rather more than that, and on that the interest of 7.5% will be given to you. That is, after the 5 years, you will not have plain the interest income, but also the compounding effect will be there, and you will have a good sum of money. After the 5 years, when your FD will mature, you will get a good sum of money. So it means you are getting a regular flow of income, and if you are not withdrawing that regular flow of income, that is the interest, then after a period of time it will appreciate also. The value of the deposit which you have made in money terms, it will increase. I am not talking of the real terms, I am talking of money terms. Real terms means incorporating inflation. At the moment I am not incorporating inflation. So it means the return can be like take another example. If you invest in, say, securities, securities means shares, then the investment which you make, the value of your investment means if I buy shares worth 1 lakh rupees of X company, right, and tomorrow if there is a 20% tomorrow, means after a year or 2 years, 3 years, it may appreciate by 20%. So there is a capital appreciation, plus this investment of shares will give you dividend. If the company is a dividend paying company, is a good company, it pays regularly good amount of dividend, so you will get a dividend yield out of it every year or every 6 months. Normally good companies gives dividend not only on an annual basis, even after they give also interim dividend. I hope you know the word interim dividend. The dividend that is being given between the two annual general meetings, right? And in the annual general meeting, final dividend is being passed, and if the board of directors wants to give dividend between the two annual general meeting, the board by its own meeting can pass a dividend that is called interim dividend. So it means every 6 months you will get some interim, some flow of income, that is in form of interim dividend, and after a period of time, if the shares appreciate, the value of the shares appreciate, you will also get capital appreciation. If you buy, say for example, real estate, residential property, this residential property which you have purchased not for your own residential purpose but for investment purpose, then every month you can get a rental income out of it. And then if you want to dispose it after 5 years, 10 years, 20 years, then if the price of that residential property increases, that will give you in form of that will give you capital gain in form of capital appreciation. So it means the investment which you make can give us the return in two forms, either some in form of regular returns or in form of the capital appreciation when you dispose it off. So investment allows people to park their fund in the vehicles that have potential to earn higher rate of return, right? Every individual tries to park the fund in an investment, in an asset that gives the good rate of return. I will not say higher because higher is a very subjective, I will be discussing it later on. Higher rate of return depending on the risk, because normally there is a positive correlation between risk and return. The asset class, if I talk, I am not talking of individual particular case, but if I talk as an asset class, right, then each asset class has its own degree of risk, and as that degree of risk increases, the rate of return also increases. For example, we say if you deposit your money in post office, right, or if you deposit the money in your bank as a fixed deposit in your saving account, this will give you return. But this return may be less than the return which you can expect by investing in the equity market, because equity market or equity shares can give higher rate of return as compared to bank FD, right, or as compared to the post office deposits. So every investment, the endeavor of making the investment is to get higher rate of return or good return, I will say. The ultimate objective of investment is to minimize risk and maximize return. This is the point I was making. Every investor wants that the investment which he is making or she is making, it involves less of risk and high return. There is no outright formula by which I can say this investment will give you less risk and more return. You have to make a balancing act depending on your risk profile, depending on your risk bearing capacity. Like, just to give you a raw example, I will say people who are the pensioners, they have less risk profile. Normally, I am generalizing, it depends on individual to individual. But if I generalize it, I can say people who are 65 plus or 60 plus, their risk profile is being considered less as compared to a young person who has a long working life, a person who is of 20 years or 25 years and starts earning. The risk profile of that individual is more as compared to a person who is in the age of 65, because now in the age of 65, I am presuming the person is a pensioner, he is or she is not earning, and she is dependent on her pension income, the limited pension income, pension which he or she receives, he survives on that. So the risk profile will be low as compared to a young person. if a person who is quite wealthy, right? So the risk profile of the wealthy person will be more. He will able to, because even if he loses some money, it is not going to impact him much the way it can impact to a person who is of low income group. So different individuals have different risk profile. Keeping in mind your risk profile, you try to maximize the return. That is the objective of, or that is the what we mean by investment. Three basic features which are common to all type of investments are commitment of present funds. When I use the word commitment of present funds, investment is also like postponing the present consumption. When you are postponing the present consumption, supposing my income is say 2 lakh rupees per month, and out of this 2 lakh rupees, I am consuming only 1 lakh 50,000. Rest 50,000 rupees I am saving. So what this means is, my regular flow of income of 2 lakh rupees I could consume, but I am postponing the consumption worth 50,000 rupees for my future, so that I can create wealth by making investments, by making productive use of this saving. So what I am doing is that I am sacrificing my present consumption, and my savings which I am making of 50,000 rupees per month, this savings I am committing to some productive use. That is, I'm deploying this savings in some asset class which can give me a return, right? So it involves commitment of present funds. Expectation of return in future. I've already talked about this, that whenever we make investments, what is the purpose? I'm sacrificing my present consumption. What for I am sacrificing, right? Or if I am making an investment of this saving of 50,000 rupees per month, which I am making by postponing my present consumption, my purpose of committing the fund is that this investment will give me some return, right? So I am expecting that it will give me return. For that very purpose, I am committing the present funds. And risk return trade-off involved, right? So it means every investment you have to keep in mind the risk and the return. I have given you the example of bank FD. Bank FD is considered to be the minimum risk investment. If you are making in a scheduled commercial bank, you are depositing your money in the bank FD. Never in the history of this country banks have failed. Means commercial scheduled commercial banks have failed. Government of India's banks have failed, right? And whenever even the private banks have failed sometime, smaller banks, even the government Reserve Bank of India, our central bank, has rescued them, right? It has protected the interest of small savers, right? So means the risk is minimal in the bank FD, but so is the return. On the other hand, if you invest in real assets, it means if you invest in say real estate, means properties, commercial property, residential property, the return can be very heavy. I mean 1 crore rupees of plot can become after 3 years 2 crore rupees, but the risk is also heavy. The price appreciation may not take place 5 years, 10 years, 15 years. In my personal life, I have experienced that many a time if you purchase a real asset, real estate, right, means residential property or commercial property, many times even for very longer period of time, it does not increases. And if you purchase a plot, say, right, so it doesn't give you a regular flow of income. If you're buying a residential property, you can let it out and this will give you a rental income. But if you buy a plot, residential plot, there is no recurring income by which you are getting out of by purchasing a plot of 1 crore rupees, right? And how long you will have to wait for capital appreciation, it depends when it will appreciate. It may appreciate after 2 years, it may appreciate after 6 months, it may not appreciate for years together. So what you have to do is, as a prudent investor, you have to make a trade-off. Trade-off means the balance. That is keeping in mind your risk profile, that you have to trade off between the risk and the return. Means don't park all your investment in very risky assets, and by making some safe investments, like I am saying bank FD, public provident fund, post office deposits, even bonds, government bonds, treasury bills, then you can, after making certain amount of investment, you can take a risk that you can invest in certain risky asset which is called like equity shares, right? Like even gold in the sense the price of gold fluctuates. That's why we say that it's also a risky asset, right? Because the fluctuations, their rates are never static, right? It keeps on fluctuating. So any prudent investor has to make a balance between the risk and the return. Investment environment is volatile. Always keep in mind there is a term called VUCA. VUCA means volatile, uncertain, complex and ambiguous. The whole environment is uncertain, is complex, it's ambiguous. Say for example, you never know what type of geopolitical risk can arise. It has been observed whenever the geopolitical risk increases, I mean suppose there is a war between the two countries. At present the war is going on between the Ukraine and Russia. So there is a political risk that it may turn out to be, God forbid, it may turn out to be the world war. If it so happens, the equity market will be greatly affected. It is affecting the oil prices. The oil prices have increased, right? It can affect the equity market. The risk will increase. It means environment is uncertain, and whenever the risk increases, some asset class increases, means some asset increases, the price of some assets increases, some assets decreases. Not something has happened in that asset, but because of the volatile situation, because of the uncertain complex situation. Means whatever is happening in the world, the whole world, I mean all the countries are being affected by other countries. India is developing well, right? We have a reasonably good growth rate at present. But if there is a recession in America, if there is a recession in Europe, I mean there is a likelihood there can be a recession in America, there can be a recession in Europe, right? So our exports will be impacted. When our exports will be impacted, certainly our income will increase, our income will be impacted and it will affect the equity market. What it means is that in this volatile, uncertain, complex and ambiguous situation, you have to be very careful while making investment. That's why we always suggest make the portfolio of investment. I'll be talking that portfolio of investment later on. But you have always to keep in mind that whenever you make investment, the situation is, I mean, VUCA, it is volatile, uncertain, complex, ambiguous, and whole investment environment affect the price of that asset. Either it may increase or it may decrease. So now coming after talking of this investment, meaning of investment basically by and large, now let me talk of the two type of investments that are there. Normally investments are being categorized in two categories. One is called financial investments and other is called real investment or economic investment. When I talk of financial investment, means financial investments are basically claim over other assets. If I buy the shares, suppose share is a one class, equity shares, right? Equity is one class, debenture is another class. There are different type of assets, money market, right? Treasury bills, commercial deposits, these are various money market instruments. So financial investments are the claim over the other. If I buy the shares, what I am doing? I am buying a claim over a company. That is what is share? Basically it is the small portion of the capital of a company, right? Say XYZ company. So I have a small claim over the asset of that company. So financial asset investments are the claim over the other. It is in form of equity share, it is in form of bonds, it is in form of commercial deposits, right? There are whole host of there are options, derivative market, right? So these are all financial investments. The other is real investment or economic investment. Real investment means some asset, like say if you invest in gold, if you invest in real estate, if you invest in art. These days painting and art is also a very good investment, especially in the higher income group people do invest in paintings of good painters or painters who are highly reputed, and the value keeps on increasing, the value of their paintings keeps on increasing. So now let me talk of little bit detail about the financial investment. Investment made in financial assets is known as financial investments. And what are these financial assets? These includes shares, debentures, bonds. I mean debentures and bond is different nomenclature only. Mutual funds, treasury bills, right? These days especially in a country like India, I mean the mutual funds, the investment in the mutual funds is increasing at a very fast rate. People are realizing the importance of equity investment, and those who cannot make, or who are not professionals, who do not have the much I mean time and energy to make their own research, they are always being advised to go through the mutual fund routes. And through mutual funds have different schemes catering to the different type of investors. It may be equity mutual funds, it may be bonds mutual funds, it may be gold mutual funds, it may be even REITs these days. REITs, real estate investment trust, right? So you buy some property, you create some property, a company creates some property, and on the base of that property, the income that the property will generate, right, that will be given in form of income to the REIT investors. We call it REIT, means REIT, Real Estate Investment Trust. So there are a whole host of mutual funds, REITs, treasury bills. Treasury means government securities, right? Money market operations, we call it. Money market means very short term money is being dealt. Money for very short term purpose, lending and credit is being given. So these are various asset classes, right? They are not real. You can't, I mean, there is no, these all financial assets are claim over the other assets, right? When I say mutual funds, what mutual fund do? Suppose I am talking of the equity mutual fund. Equity mutual fund means the mutual fund house buys equity shares of different companies, right? So the equity share has a claim over the company, and a pool is being created, that is called mutual fund. When you talk of the treasury bills, Government of India offers 10 years bonds, right? And this 10-year bonds will give, say, 7% interest annually. So this Government of India bonds, what you are doing? You are buying a bond. Government of India treasury bonds you are buying, or you are buying, say for example, different tax-free bonds. When you are buying a tax-free in order to save your tax, what you are doing is you are making a claim over the Government of India that this much money which I am lending to you, you will give me in form of interest, and after a period of time you will return my money. That is, you have a claim over the Government of India to take that money. So that is means financial assets are claim over the other assets. Investor can earn return in the form of dividend, means if you are investing in shares or equity, you can get in form of dividend, interest or appreciation. If you are investing in bonds, say debentures, bonds, normally in India for companies, corporates, we call it debentures. For government companies, we call them bonds, or the fixed interest securities that is being offered by the Government of India, we call them bonds, right? But by and large, these are more or less of the same features. So debentures and bonds give you in form of interest, right? Some investments gives you in form of capital appreciation, like if you invest in the mutual funds, right? So in the mutual funds, the value of your NAV, we call it net asset value. If the NAV of the units increases, your capital appreciation will take place, right? So in financial assets, you have different asset classes, and the purpose of investing in the financial assets is basically to get capital appreciation and a flow of income, means in form of interest, in form of dividend. Coming to the real investment, as I said, real investments are investment in some asset. Investment may be in machinery, building, land, gold, paintings, right? So investment made in real or tangible fixed assets is known as real investment. It includes building, plant, machinery, equipments, painting, gold, commodities, oil. These is lot of investment is being made in commodities also. So that is also real asset. You buy oil, you buy gold, you buy silver, you buy, whole metals, all these ferrous, non-ferrous matter like steel and all these things. And there are different exchanges these days. There are, even in India, you might have heard MCX, right? So in MCX, only the commodities are being dealt, only commodities are being exchanged. You may not be buying it in physical form, but that is a investment in real assets. that is investment in gold, investment in machinery, investment including. So investors can earn a return in the form of rent or capital appreciation. See, when I use the word rent in the real investment, suppose I am buying a commercial property. That is, I have bought a office in some mall or something like that, right? Or I buy a shop and I let it out. So the income which I am getting, because why I have purchased it? I am a first class person. Why I am buying a shop or why I am buying a office? I am buying it for considering it is my investment. Like if I have purchased a office of 1 crore rupees, I'll let it out and this will give me a rental income every month, right? And I am presuming that the value of this office, the price of this office will escalate over a period of time, will increase over a period of time. That will give me the capital appreciation. So the real asset can give you in form of rent, or means if I buy asset. Suppose if I buy gold. When you buy gold, gold doesn't give you a regular flow of income, unlike the real assets, means real assets means the real estate, sorry. So when I invest in real estate, that is commercial property or residential property, I may get a rental income, or if I let it out, I will get a rental income, and I'm also expecting a capital appreciation. But if you buy, say for example, gold, gold will not give you a regular flow of income. The gold is not a productive asset. It will give you buy hold either in physical form or electronic form. These days even these real investments can also be made in can be also invested through electronic form. In this electronic form, it may not give you a regular flow of income, but after a period of time the value of the gold increases, and it has been observed over a period of time that the value of gold appreciates over a period of time. So when you will dispose it off, the capital appreciation will be, you will be getting capital appreciation. So this real investment will give you income in maybe a regular inflow of income and in form of capital appreciation. Some asset will give you only capital appreciation. Say for example, if you buy a painting of a very reputed painter, so that will not give you a regular income, but the value of that painting, the price of that painting will increase over a period of time. And then when you dispose it off, if you want to be, right, so then if you want to dispose of, it can give you good capital appreciation. So these are the two different type of real investment. So I'll be continuing about the investment in my next lecture. Thank you very much.